easiest exam. But anyway, yeah, so we're not going to do much else with chapter 10. We're going to have, there's going to be there's two methods. There's the current method, which we've already covered, and then there's the temporal method, which we'll cover today. And that's basically what the exam's going to be on. All right, so let's see here. Oops, wait a minute. Too much stuff going on here. So I think we did problems 1 and 3 on the chapter 10. And oh, I know what I want to talk about real quickly. Someone was talking to me about how that, you know, when they do the handouts and stuff like that, they do it by hand, and that, you know, then they transfer it into the document to send it to me. You don't need to do that. You can just take a picture of it, you know, whatever you have, however you did it. So I must not have been very clear on that, but you don't need to transfer it from one to the other. Another thing I'll tell you about though too is doing things by hand is actually, it's funny here. Doing it by hand is probably the best way to actually learn it, to memorize it. And when we do the CPA exam, we do it. I got a handout on it. I'll show it to you guys. But anyway, you know, if you do it by hand though, that's fine. And you don't even, if you do it on notebook paper, that's fine too. Just take a picture of the notebook paper. So you do not need to, you know, transfer it onto the other document to download it. Okay. All right, I'm going to copy this over. Yeah. And what we're going to do on problems 2 and then problem 4 are the what they call temporal methods. And this is when the functional currency is in US dollars. And notice that there is a kind of fundamental difference when it's done in US dollars, because the actual amounts that are paid, I'm going to hide this one. So this is what we're using. So the temporal method, everything's in US dollars. So basically what happens then a lot of times, especially for the finite transactions, for transactions that are they're done at a specific time. Those transactions, so for instance, let's say you buy an asset on June 13th. Whatever the exchange rate is on June 13th, that's what that historical cost for that asset goes in as, whatever the exchange rate was, because this is in US dollars. And whatever the US dollars were on that date, that's, you know, the exchange rate. You buy another asset on June 21st. Okay, it could very well have a different, you know, historic. So you can actually have dozens, thousands of historical rates going on with the temporal method. Whenever you have specific, you know, cash transactions on those dates, you know, and you can have weird things happen too. Like, let's say that you have an asset that you bought and you sold it. Maybe in the foreign currency you have a gain. It's possible that when you translate it, you have a loss because the exchange rate is different. So even though you bought it, you know, in the foreign currency, and maybe you have a gain in the foreign currency, you may have a loss in the US dollar. Okay, so it's kind of a strange method, but it's because everything gets translated immediately, basically, into US dollars. Okay. So let's take a look here. So this is, I think this is the same as the first one, isn't it? Maybe not. Yeah, I think it is. Okay. So anyway, we'll be able to kind of compare it to the first one when we get done with it. Okay, so let's go to the income statement. It's gonna be a little bit wackier. And revenues and most expenses will still be average. You know, you make a sales throughout the year, you pay the rent and insurance and all that stuff throughout the year, employees. So there are still stuff that are average, but there's also a lot of stuff that is going to be historical. Okay. So let's see how this works. Revenues are going to be average. Oops, no, let's make them that color. Okay, so average. All right, so we're going to have 125 for the revenues. Hey. Sorry, let me format these cells here. You know what? I gotta check and make sure that I got your right when I send out your exams, I want it to be formatted. Okay. Now, cost of goods sold. Cost of goods sold is going to be based on the inventory, which we're at inventory historical. So this cost of goods sold, this will be inventory. You know, these are the goods that were sold out of inventory. So inventory historical, we'll make it that one. That color. Okay, operating expenses without depreciation. Those will just be most of the expenses, so this will just be at the average. We're gonna copy this. Depreciation is going to be at the historical. Now, this, they purchased the company on 1/1/21. So this is going to be the historical for that property, plant, and equipment. So property, plant, and equipment was brought in on the first, and that was that. Gain on sale, it's the same as before. On 430, so we'll just go to 430, that's 22. Hold on. So this will be our net income for this temporal method. I'm gonna peek back at here and see what it was. Okay, so a little bit different net income. The net income here was 52,000. 60,000. And there are some, you look at, there's some difference here, and these can be kind of all over the place. For instance, the gross profit, there is no average for that, or exchange rate for that. It would, because this is already a composite. So when you look at here, this is a composite. Bunch of different ones. Okay. Beginning retained earnings will be, at least initially, will be at $1.30. Bold these. Dividends paid, again, they're paid on a specific date, so we'll use that specific date, $1.26. So the ending retained earnings is 288, and this is a composite too. It's made up of all these and then these. So okay, let's go to the balance sheet stuff. Now, basically, those things that are redeemable in foreign currency will be at the current rate. So cash, receivables, current rate. So we're going to use the current rate for that, which is the ending. Wow. Make it that color. Oh, is that too dark? I don't know. Can you guys see that? I'll make it a little lighter. There we go. Inventory is done at the inventory historical cost, whatever we bought it for at the time. That's what we put on the books at. It's kind of like making a cake. It's like, go get this. Stir that in. Go get this, stir that. And property, plant, and equipment, this was brought on at the beginning of the year. So this will be the same historical for this. It'll be the 1-1 historical. And again, you can have literally dozens of different historical costs because it's whenever it was whenever these were purchased, or in this case brought in, that's what uses historical costs. And you could have, if you bought 30 pieces of equipment throughout the year, you could have 30 different exchange rate, 30 different historical costs for them. This method can be kind of a pain. Okay.
Question for you, Professor.
Yeah.
How did you come up with the property, plant, and equipment 130 average? I see you went with the historical, but why historical?
It's whenever it was put on the books, And I am assuming that they put the property, plant and equipment, when they bought it, they purchased it on 1/1 of the year on the January 1st. So because they purchased it on 1/1, that it would probably go in at the 1/1 cost of 130.
Gotcha.
Because that's when they bought it. That's when this equipment was on the books, and that's when they bought it at.
Gotcha. Thank
Yeah.
you.
Yeah, but I mean, it is kind of a, it's kind of a pain. And so what they usually do is kind of carry it over from one year to the next. You might be wondering, well, do we have to keep all these rates? Like going, you own a subsidiary for 30 years, you can imagine what this looks like. And what they usually do is just carry over retained earnings. And, start fresh every year with, the new whatever. They'll still have the historical rates for things like depreciation and stuff. But a lot of like these averages and all that kind of stuff, they don't keep those around usually.
Professor, I have a question.
Yeah.
Going back on the income statement, how do you get the total for gross profit, 145,300? I missed that point.
Here?
Yeah.
These two.
These that between. Oh, okay, got you. Thank you.
And but is a good point is that sorry, a good point about that is that these are on the one on the previous page on the current method. You'll notice that these both went in at 125. You could have just taken 110 at 125 and you come up with that number. You can't do that on this one because the inventory is at historical cost. So, I mean, you could back into this number. I guess see what it is. You don't need to do this. This is just me goofing around.
Got you. Thank you.
Me goofing around so much, I didn't do it right. But yeah, so I don't even know what this would come out to. And net. Yeah, well, that's a meaningless number. I don't know why you put it in there. So the true. It's a composite. All right. Yeah, so yeah. Now coming down to the liabilities, most of the liabilities are going to go in at the current rates. And the current rates are it basically is okay. We owe this currency at the year end. So whatever the year end rate is, that's what we're going to use. The lone exception of that is deferred income. Oops. Because deferred income is like unearned revenue, and someone pays you ahead of time. So generally, they give you that cash at one point. It's cash, but it's in foreign currency. But they pay you that cash at us, so maybe they give you the cash on December 1st. Well, whatever the exchange rate is on that December 1st, that's what you are going to record. We got that cash on December 1st. We changed it into US cash on that date, or pretty close to it. So that's the exchange rate we're going to use for that unearned revenue or customer deposit. So however you want to put it. So that's the only liability for the temporal method. It's a little bit wacky. Is that deferred income one? This is basically unearned revenue. Yeah. Okay, so current liability. So these can go into current rate. I think it was that, right? Yeah, current rate is 132. Okay.
Professor, I have a question here.
Yeah.
So that's on the deferred revenue. How about on the AB side? If you have like a contractor he get paid like in local currency, and you calculate, so you just calculate his like wages at the day of the payout, right? So you get the exchange and you make the entry there. So same principle.
If it was if you're doing like a job, the job kind of costing stuff like that, Yeah, you would have, actually, you would have historical costs for whatever those are on those dates. Revenues are basically, you know, if you're making sales throughout the year and they're pretty much even going in, like if you're selling, you know, trinkets, whatever they are. But if they are, if you're running a business that is for a specific job, like, you know, you like say you get a contract with somebody, if you fulfill the contract and the money exchanges hands, that's basically along the lines of those of the of like the inventory kind of thing. When it exchanges hands, that's when you count it, because it'll be exchanged into US dollars at that date.
Yeah, thank you.
Yeah, if it's average throughout the year, then you just use the average, but if it is and two, you know, there are times that they'll say that the inventory should not be valued at, you know, or the sales aren't, you know, going to be at the average if it varies too much from year to year, or scratch that, varies too much during the year. Yeah, like well, like, you know, there's some places that make, you know, for instance, the holidays, you know, they'll have half their sales in December. Well, for those places, you may do average like through, you know, months, January through November, and then whatever the December ones are, you may do an average for December even. So, you know, there is a little bit of leeway in there, and you try to get it to be somewhat accurate.
Thank you.
Okay, common stock, beginning of the year stuff, so this will be at the 130. Oh wait, I didn't do any of the multiplication here. And retained earnings will be our I'll make that a little more visible. Oh, all right. So retained earnings. I just did that wrong. Hold on a second. Oopsie. Ignore what that. Oops. That cookie guy is doing. This is for this one. Okay. So our translation gain or loss will be what? Let's see, 624. Is that a gain or loss?
Isn't that a loss?
Yeah. Yeah, you have more liabilities than equity, more people you owe money to than assets that you have, so this will be a loss. And that loss will go on the income statement of the parent company. Because it's all changed into US dollars, and then it'll also go in there. But now, you know, it's not always as cut and dry as you might think, though, because at 60, you know, here, let's go back here. So this one, we had 52,000, but we had a gain of 7,500. So whatever that is, that's probably around, well, ballpark a little bit more than 60,000 total. So this one, while we do have this loss, we do actually have more income up here. So this is like 45,000 total. It's a little bit, you know, you'll notice that even though we have more income, our loss is larger. And that's just because of the fluctuations. You know, and you know, the different method that we use. And so here's what happens. this retained earnings you'll keep, and this will you'll start with for the next year. So the next year. Yeah, you notice the next year they'll say, you know, these are a composite, because this is a composite, and this is what you're gonna start out with here. The following year, you're gonna, instead of 247, you're gonna have 288, 175. You're gonna start out with your beginning retained earnings in January 1st, 2022. And you'll just keep going. And again, this number, as you know, has a whole bunch of stuff wrapped up in it. You know, a whole bunch of different things wrapped up in it. But you'll just start out with this and then keep going. Now, when you do things like the depreciation, anything that was still left over in this equipment that is still on the books, you'll depreciate it at this historical cost. It is possible that you bought more equipment, they'll be done at a different historical cost, but yeah, anything that's part of this 225 will still be depreciated using the historical cost of the historical rate, I should say, of 130. And again, one of the reasons why we're doing this is, you know, a lot of times when we do the combinations, the consolidations, a lot of times they are foreign subsidiaries. You know, one of the things that companies will do oftentimes is buy another company, you know, instead of trying to make your name in another market. You know, you buy the company, an established company in that market, and a good example of that is Fiat. Fiat owns Chrysler. Fiat's tried to come into the American market and has never worked out well, but Chrysler is a pretty good name, and so you know they bought Chrysler in the American market. You generally can't get Fiat. I think they may make the little Fiats. I think there's some of those, but I don't know if those that are imported anymore. But anyway, long story short, though, they sell a whole lot more Chrysler than they're going to sell Fiat in the United States, and so they have that foreign subsidiary, and it really depends on how integrated it is into their cash flows. Okay, let's go ahead and do number 4. By the way, I don't know if I mentioned this. I should have. Hopefully, we'll be done a little early tonight, because these really don't take that long to do them. Okay. This one's like number 3, I think. Yep. So this is number 3. So this again, we're going to kind of compare and contrast when we go back to this one. Okay. Oh wait, I know what I don't have. I don't have my this. Copy that over. Oops. Watching me how to learn how to use a computer. Okay, so this is the temporal method. Functional currency is in US dollars. Purchased on 1/1, just like the other one. The problem we have on the book is going to be purchased was from a previous date, so we'll get to see what that looks like. I'm going to bold this. Okay. Average rate. Things like sales can be done on average rates throughout the year. Oh, I gotta format these. gonna make a note to myself right now. Format columns. And put the methods on the side. I mean, you guys can do that. It's just not. If I can do it all at once, may as well do it all. All right, so cost of goods sold will be done at which rate?
The inventory historical.
Yep. And this is a composite. It's got more than one rate. Okay, operating expenses without depreciation. So the normal operating expenses, you probably pay rent every month during the year, you pay insurance, you pay whatever, and usually, it's probably going to be an average throughout the year. Oops, no, move that. Depreciation expense. This is going to come from the property, plant, and equipment.
So that would be 133, right? The one January 1st.
Yes. And for the entire length of time, we have that equipment until it completely depreciates. We'll use that same historical. And for this depreciation expense, you may have dozens of different rates that you then combine them on. Okay, sales on 6/12, 125. Oh, wait a minute. I don't want all those to be. Okay, so 219 minus. So this will be our net income, and that is also a composite number. It's got more than one rate. Okay, the beginning retained earnings, now this is only for the first year, is going to be whatever the historical were when you purchase this company. And so that'll be the beginning retained earnings. After that, it'll be a composite. The net income is just that. All right, dividend were declared on 10/31. 129. Oh, oopsie daisy, let's try that again. And by the way, this 129, it is possible you have, so for instance, these two are the same. That's just a coincidence, maybe an unhappy coincidence. And so this will be your retained earnings, and this retained earnings, obviously it's a composite. And that's what you're going to transfer from one year to the next. You're not going to keep all of this in there. You just transfer that. That'll become the beginning of next year of January 1st, 2022. Okay, cash and receivables. It looks funny. Seems like it's too wide. All right, cash and receivables. Those are going to go on at the current rates. Marketable securities are just short-term investments. We don't have any of those. I don't know why I got an extra S in there. I didn't see that before. I know why. It's because I want to give you guys good value for your money. I put extra S's in there just to something other teachers don't do. I do that just because I'm a knucklehead. All right. Current. It's a little too dark. Let's go. I don't know. Is it too dark? No, it's not too dark. So cash and receivables, those are in foreign currencies. Those are what they're valued at the year end. Inventory is at the inventory historical. Plant and equipment are at the historical when you bought the place. Okay, accounts payable. Your liabilities, with the exception of the deferred, the unearned stuff, will just go in at the current rate. Common stock will go in at the historical rate when you bought the place. 133. And retained earnings is just that composite number from here. They're pretty close. Let's see here.
It's 120.
120. Gain or loss?
Gain.
Yep. Yeah, you have 128,400 in assets. You have 128,280 in liability. So that's what you owe basically. So this will be a gain. It's not a gain, a gain. 120. What was this? I think it was 86. And they had a gain of 12. So total's gonna be a little less. This translation gain will go on the income statement of the parent company. And the idea is that it actually is a real, that the transactions, that there's an accumulation of the transactions in US dollars. So that's why they put that on the income statement. Question on that? All right, let me save that. Next thing we're going to do, last thing actually, is the problem 1033. Okay, so let's see here. All right, exchange rate, let's see additional information. So here's the exchange rates for the different dates. All right. So common stock, I'm just gonna put this down here. The historical for common stock. $208. And the historical for property, plant, and equipment. 159. No, I'm saying no, it wasn't. It's $2. So I just took these two and moved them down. Just to get them a little closer to what we're doing. Retained earnings translated as of January 1st, 2020. Okay, so this is that composite thing I was telling you about. Yeah, they just give you the total amount. All right. Translation adjustment from last year was this. We'll get to that later. All right, so see, weighted average rate was here. So that'll be for our sales. Oh, wait, what method are we using? Current rate. Okay, this is a current rate method. That makes a difference. All right, current rate method. The weighted average throughout the year. That. Cost of goods sold under the current method is the same. You know, I should have, I don't know. I do. I'm gonna just highlight this and put it under the. All right, everything, pretty much everything goes under the current rate. With the exception of the gain on the sale of equipment, because that happened at a specific time. So gain on the sale of equipment, when was that? Equipment sold on September 1st. Okay, so let's give that a color to match it up. Let's say green. So equipment was sold on September 1st. It's a green, but it's not the same green. It's a minty green. Okay, so this will be 172. So we'll add these up. And this is going to be a composite. This actually, the gross profit on this one is not a composite. It's the current rate. But down here, this will be a composite because we have this 172 in there. So this is going to be our net income. Coming down. Our net income is 114. Dividends. Dividends were paid. Yeah, here we go. Dividends. Dividends declared on April 1st. It's a composite too, obviously. And by the way, when we start next year, this will be what we start with. Instead of the 396, we'll start with the 468. Okay, balance sheet. Well, this should be easy. Everything goes on at the current rate. And this is the current rate, December 31st. This is the current rate. It's kind of a funny name for it. When you think about it. Oops. It's not a very good formula. All right, let's see, liabilities, those will go out at the current rate. All the liabilities go out at the current rate for this method. Even the customer deposits. Or deferred income, I guess. Okay, they say the common stock, the historical common stock was 208. Retained earnings is that. Line for translation gain or loss. And so this translation gain or loss, this will. Is that wrong? Hold on a second. No, I didn't say that wrong. The foreign currency, the current rate method that goes into comprehensive income, and the temporal goes into net income. That's right. Oops, sorry about that. Yeah, so this is a foreign currency. This is the this will go into the comprehensive income, not a net income. Question on that one? So let's kind of review the foreign currency one. And foreign currency one is actually the easier of the two to use because they have everything. Most of the stuff goes in the average cost for the income statement, and most of the stuff goes at the current rate or year-end rate for the balance sheet. So it's an easier method to actually to do. Okay, let's do the temporal.
Professor, for a moment and scroll down.
Sure. Yeah, I'm gonna get a screenshot of this. Actually, I can back it out a little bit more too. think I can get it all in. That's everything.
So was that one a loss there, right?
Oh, yes, yes. Sorry, that is a loss. Yeah, basically you owe 989 and you have assets of 857. And the big kicker here is that the 208, you know, the foreign currency doesn't buy as many US dollars as it used to. So that's why, you know, this looks so much bigger than this. Okay, let's go to the temporal method. And as part of my showing you how to be lazy, I'm going to copy down those two. Over there. And so temporal method a little bit more involved. I'm missing something. See the income statement. Hey. Okay, I'm missing a bunch of stuff. Hold on a second. Okay, I'm not teaching you to be lazy very well. Okay. Oh, I have things hidden here. Whoa. Oh, I know what that is. That's all my stuff that I moved there. This is the same thing we have over. I moved it to the other side. Sometimes being lazy isn't the easy way. All right, so let's go ahead and fill these in. Oops, sorry. I didn't mute myself. Sorry about that. By the way, it's 7 o'clock, but I think we just push through. This will take like 10 minutes. We'll be done with it. You know, do something else the rest of the night. Okay, so let's just push through. So let's see. Oops, down here, income statement. This isn't right. Oh. It's not right. What in the world did I do? All right, I'm gonna go back to the one that I know is right. Apologize for them. I think that must have been an old one because I changed it to put the income statement at the top, which makes more sense to me. Where's the other one was? Oh. Just did this wrong again. Actually, no. Okay. This is what we should have for it, and I apologize, I will make sure. When I send out the test, that they have the correct ones on the correct order. Let me check and make sure, yes, that's fine. Okay, all right, so exchange rate. Weighted average, we're gonna use for most of the stuff on the income statement still. Okay, so. Cost of goods sold, we're gonna use a historical cost. That's gonna be the inventory. We're just gonna fill these in and then. Depreciation. Will be for the property, plant, and equipment. It was $2. Gain on sale of equipment, equipment was sold on September 1st, that's gonna be exactly the same as before. Let's zoom in a little bit.
Professor, the gain on the equipment, how did you know that was for September 1st? I don't see a date there.
Equipment sold.
There, oh, it's in a different, okay, section.
Yeah, they kind of moved all over the place here.
Okay.
Give me 1 second here. Sorry about that. I'm sneezing like crazy today. I don't want to take Benadryl because I'll fall asleep and you guys will have a video of me snoring or something. All right. Retained earnings, they gave us the amount for that, I thought, right? Yep. So this is the retained earnings amount. This is, they gave us that, so that's gonna be just net income is the same as we had up here. And dividends were paid on April 1st. I already have that one. So this will be our ending retained earnings. Next year, this will go up here. We are beginning retained earnings of January 1st, 2021, I guess. Okay, cash and receivables, they're gonna be in the current rate. And the current rate is the year-end rate. So this is the current rate. I know it sounds it's kind of, I don't know, kind of funny, but. So current rate's 154. And these are what they call financial assets, so those will go in at the current rate at the end of the year. Inventory will go at the historical average. And property, plant, and equipment will go in at the historical cost. I guess I need to copy these two. Liabilities going at the current, except for deferred income or customer deposits or when someone pays you ahead of time. So let's go in at current to current rate, and so that is this. Common stock. 208. Retained earnings. Oh, wait a minute. Translation gain or loss is, let's see, this is that right? Hold on. Yeah. Gain or loss?
Gain.
Yep. So that'd be a gain, and that will go on the income statement. It goes in the income statement because it's basically, this has all been exchanged into cash. We now have 32,710 more assets than we owe. So that'll end up being a gain, and the gain will eventually go into the income and into the retained earnings stuff. And again, the retained earnings will be held over for the next year. Now, these other rates, though, like for private plant equipment, they'll continue on until those are completely depreciated, and any new assets will go in at the new rates. So again, you can have many, many historical costs for equipment and things like that. Back us out a little bit so you can see the overall. Okay. All right, let me see. All right, 713. That's a new record, I think. All right, so I'll send out the exams. I'm gonna go over them just to make sure that, especially the Excel ones. I think the other ones are okay. I'm gonna make sure the Excel ones. I transferred this stuff into Excel, and some of the flavor got lost apparently. So anyway, I will go ahead and make sure that those are all situated before I send them out to you guys. But probably like in the next hour or so, you should get the chapter 10 exam. It's due a week from Friday. Actually, being the cruel, sinister teacher that I am, the other one is due this Friday, although I think most of you guys already have the chapter 3 exam in. But anyway, so the chapter 3 exam is due this Friday, so that's what concentrate on. And then this one is due a week from Friday. Okay, any questions? All right, 714. There's a record. All right.
Yeah, no, professor, it's good. Thanks.
What was it? Okay.
I was saying no, I didn't have any questions. Thank you.
Let's say anything. All right. I'll see you guys